Welcome back to NYSE TV Live, everyone. I'm Kristen Schiller here in the studio. Well, we got to talk about this market because it's been 4 straight weeks of losses. We had seen the S&P 500 and Thursday session up fractionally on the week by about 0.4%. But investors are still a bit pessimistic this morning with the S&P setting up for a fractionally lower open. Joining me now for more on these markets is Tim Urbanowicz. He joins from Chicago. He's a chief investment strategist at Innovator Capital Management. Tim, it's great to have you on the show. And as we follow the twists and turns here in equities, what's on your radar?
Well, Kristen, I think it's all about uncertainty right now. And I think you have this growth scare out there. I don't think the news from Nike yesterday really helped. That guidance was particularly concerning. And I think it all comes down to the consumer and what impact are all these different policy changes going to have on the consumer that is already reaching its limit. So I think it's growth scare. But when we're looking at things right now, we're talking to advisors, there is a lot of uncertainty. It's very difficult to model out the economic and financial impact of tariffs when we don't know what the end game will be there. So uncertainty is the name of the game. I think a lot of advisors that we're talking to now are very concerned. They're nervous, and they're just expecting this continued volatility here in the short run.
So how would you recommend that investors adjust their portfolio in this particular environment?
Well, Kristen, right now, I think it's all about preparing for a wide range of outcomes. This almost reminds me of like a COVID type scenario where you really can't go to your traditional financial modeling projections because, again, we just don't know that impact. So preparing for a wide range of outcomes, we are seeing tremendous interest to the tune of about $5.3 billion of inflows this year into buffered ETF strategies, strategies like ticker BALT, where you have a known level of downside protection, a known buffer against losses, but you're also maintaining upside exposure up to a cap. Those are growing in popularity significantly in the advisor community, and especially given all the tariff uncertainty right now, because they allow you to stay invested while still making sure that you're in control of that downside risk with the known buffer against losses. So we continue to lean into those. We think they make a lot of sense right now, just given all the uncertainty that is out there. And that's how we're seeing advisors allocate right now.
Tim, what are the factors that matter from here? Obviously, you've mentioned uncertainty. We heard the Fed chair mention uncertainty, and even some of these companies, spot on, mentioning uncertainty in this particular environment. So what will give us more certainty? Is it that April 2nd deadline that we could see some of the tariffs resumed? Is it more commentary from the Fed?
Well, I mean, the Fed helped. Clearly, you saw that this week. I think it reassured investors that if things really deteriorate, that the Fed will be there and have their back. So that was reassuring. But when it comes to what's coming out of the Trump administration right now, I don't think that you can have that. It's very clear that President Trump wants to use tariffs as a negotiating tactic, and it's really just a question of how soon is he going to get what he wants, where he can peel back or even remove a lot of these tariffs. So when we're talking to advisors right now, we're estimating what the base impact will be based on what they are right now. But again, we don't know. Is this something where the impact could be very minimal if we see those pulled back in April, or it could be much more significant if we see this trade war continue to escalate? So I think that's why it comes down to, again, you have to prepare your portfolios for a wide range of outcomes right now.
How do the DOGE federal government cuts, the layoffs, Tim, factor into all of this, the economic outlook, and thus the stock market?
Yeah, well, we see DOGE as short-term pain, long-term gain. And I do think, Kristen, this is actually coming at a very good time for the economy. And for the first time, I would say in 3 years, we're getting more bullish that we can see interest rates and inflation actually come down. You saw this huge spike. A lot of that had to do with the 6 to 7% deficit as a percentage of GDP that we're running over the last several years when unemployment was very low. We still have an employment market that is very strong. Wage growth is running way too fast at 4.5+%. A lot of those layoffs that we are going to see from the government are going to be reallocated to the private sector. We think that helps really rebalance the labor market, take a little bit of stress and pressure off wages, which ultimately will help inflation and interest rates come down. Doesn't mean there's not going to be pain in the short term. We do think those layoffs are going to be painful, a source of volatility. It's going to add more fuel to that growth scare fire, if you will. But in the long term, taking government spending down, getting inflation down, and reallocating those jobs to the private sector where they can be more productive and drive more growth, we think is definitely a positive in the long run.
What is your perception, Tim, on how the president views the stock market? We had seen him here with roughly a dozen members of his cabinet even before he took office in December. I think Wall Street and the investing community view that very much as a positive, that the president was supportive of Wall Street. But we know he's concerned about Main Street as well. How does that guide the outlook?
Well, I think it's pretty clear what the strategy is. And I think that he recognizes you need some short-term pain to get those prices down, to get interest rates down, which helps with affordability for housing and all kinds of things in the future. So short-term pain, and I think what he's thinking is the sooner the better. The quicker we have some of that pain to bring prices and interest rates down, the easier it is to point back and say, hey, this was an economy that we inherited. These are problems that were created by the Biden administration. And then, that frees him up later in the term to focus more on the market. Right now, he's not thinking about it. He mentioned it constantly in the first term. Right now, you really haven't heard him mention it once outside of questions that he's been asking. It's like, hey, we're not focused on that right now. Well, I think that's going to change in the back half. But right now, I think he's okay and sees the need for some of that short-term pain to get what he wants in the back half of the term.
Tim Urbanowicz, Chief Investment Strategist to Innovator Capital Management, joining us from Chicago. Tim, thank you so much.